Well, hello and welcome to the TandemGrowth Financial Advisors webinar. Today, we are going to be talking about college planning, and we are so pleased to have a special guest today, Paula Bishop, to join us to dig into some of the ins and outs of college planning. So happy that you decided to join us. I hope you find the content useful today. We're really looking forward to hearing Paula's information. The webinar will take about 45 minutes. There will be some times for Paula to address some of your questions if you have them at the end. Just a reminder, we are recording today's webinar for those that are unable to attend. So we're just going to ask you, if you have questions, there is a question box there in your GoToWebinar panel. So you can expand that out if you want and just type in your questions there. I will monitor that. We'll take the questions at the end. She's got a lot of information, and it's possible that some of the information that she gets to might even answer your question. But if you'll just type it in the question panel there, the last 10 or 15 minutes or so of the presentation, I'll relay those questions on to Paula, and she will address them. When we set up the webinar a month or so ago, we started putting out a little marketing, and we called it the 8 questions asked or answered. And so it's actually, the name of the presentation is How to Pay for College Without Going Broke. And so I think you'll find this really, really, really useful today. Just as a reminder, TandemGrowth Financial Advisors is a wealth management company. We provide comprehensive wealth management services. And, we have our mission is to help our clients create the clarity and confidence to live a great life. And we do that through doing comprehensive advice on a whole host of financial matters. We believe in deep relationships. We believe in the financial planning process as a process to help us give independent, objective advice, again, on a whole host of financial and personal matters that you see here on the screen. And as I mentioned, today we're going to be digging into college planning. So let me introduce Paula briefly here. Ms. Paula Bishop is a certified public accountant and a financial aid for college advisor. Her expertise is working with families to develop strategies on how to pay for college and how to find the best college for their student at the lowest cost to the family. Paula's been practicing CPA for 35 years, which allows her to combine her tax knowledge with the complexities of the financial aid system. She frequently conducts seminars to high school groups, sports groups, PTAs, and other organizations, including financial advisors, attorneys, and other CPAs. She has a finance degree from the prestigious Wharton School at the University of Pennsylvania, and she's got an MBA from the University of California at Berkeley. She's a member of the Washington Society of CPAs and the National Society of Tax Professionals. I may not have mentioned it, but she's joining us today from Seattle, Washington. Paul is the past president of the Accounting Financial Women's Alliance in Bellevue, Washington, a suburb there in Seattle. She's an active member in the National College Advocacy Group, whose mission is to respond to the challenges facing college-bound students and their families. She's frequently quoted in Money Magazine, New York Times, Wall Street Journal, and the Chronicle of Higher Education, and of course, there in the Seattle Times. She's also been a panelist on NPR and other, and I could go on and on. She's got quite a resume as it relates to college planning. So please join me in welcoming Paula Bishop. Paula, welcome to the webinar, and thanks for joining us today.
Thank you. Okay, so I think you can see my screen. Can you just confirm that you can see my screen?
Not yet. I think you need to hit the. There we go. Now we can see your screen. Beautiful.
All right. So when it says show my screen, it makes you say, okay, I probably should click on that. As Jeff mentioned, I'm also a CPA, and so it's tax season. And when you get up in the morning, do you feel like working on a tax return, or would you rather help a family with any kind of college issues that they might have? So when I'm reading my emails in the morning, I definitely answer the ones about college first before somebody sending me 50 pages of documents for their tax return. It's just a necessary evil of life. I'm trying to reduce my tax load, but definitely, the tax knowledge that I've acquired over the years helps me with the college, figuring out how to pay for college, because all of the financial aid forms relate to a tax return. So as you can see, this is University of Georgia, and I discussed with Jeff, he says it's the new business school, and to me that green grass is too round, so they must have some kind of special lawnmower to get that pristine, and it just looks like a mighty impressive building there. So you're lucky to have that location. So okay, I clicked too fast. And I first wanted to address some of the issues that I will be covering, because most parents ask me these questions. I don't know if should I file the FAFSA if I don't think we qualify for aid. We're going to go over that. Because you can file the FAFSA and just get a student loan if you need $5,500, and you don't have to qualify for aid. You just have to file the FAFSA. And sometimes you have to file a FAFSA just to get a state grant, because they just want to keep track of how many kids are applying to college and how many kids file a FAFSA just to find the interest in looking for money. And, you know, when your students are going to college, sometimes it's time to look at each other and say, hey, you know, I think we might get divorced. So we'll talk a little bit about the divorce situation. And you might have heard about some of the scuttlebutt that there are going to be FAFSA changes. And interesting, it should happen next October with a new FAFSA. They're going from supposedly 136 questions down to 37 questions. So they're getting rid of a lot of the minute questions, but it's to your favor. I gave a webinar and the details of the FAFSA changes, and people with one in college are better off with the new system rather than the old system. But one thing that's major that they're getting rid of, if you have 2 students in college at one time, they're getting rid of the multiple discount. Currently, they divide whatever the FAFSA says you can afford in 2, if you have twins or 2 people in college, a junior and a senior, and now they're getting rid of that. So the financial aid community on our side is up in arms about that, but I don't think it's going to be changed. And the typical, I've saved nothing, what should I do? We'll talk about that as well. And some of those 8 questions that Jeff mentioned, these are the typical ones. Does your family qualify for aid? How do the colleges determine aid? What about my 529? We're going to go over all of that today. And I'm hoping that you remember a lot of it, because the financial aid process is complicated and confusing. It's not my fault. I spend all my time trying to have parents understand it. And many times they say, I give up. I just want you to do it. And, you know, we'll get on a Zoom call and fill out the forms together, because so many of the questions on the financial aid forms are personal. You know, where do your other children go to college? That kind of stuff that I need you for it. I can't do that myself. I don't know where they go to school or high school. So, and of course we want to go to the colleges that have the most aid, but also one that your child won't say, Dad, I'm not going there. You know, that the child wants to go to as well. And I've gone through this twice. I have 2 children, 2 boys. One, you know, they're way out of college now. They're in their early 30s. One works for Under Armour, and the other one works for NPR in DC. He's an audio engineer. So you will live through this. Just don't have 6 kids. It's just too much to remember, you know, to go through 6 times. Now, these are the scary numbers. These are typical list price of colleges. So Duke, $81,000. You'll say, well, luckily my child is not smart enough to get into Duke. I don't have to worry about it. But depending on your income, you don't know if you're paying 81, 21, 15, 0. So we'll look at, you know, a situation where you might get some substantial money from Duke if you can get in. Kennesaw State, you know, is an affordable attraction, $25,000. They have a high admit rate. You have the Hope Scholarship and the Zell. So it could be a very low cost of attendance to go to that. And when, say you're a full pay at Duke and maybe Kennesaw is only maybe $15,000, it's a big debate in the family about which one you should go to. Boston College, $83. University of Georgia is the same price as Kennesaw State, but it's only a 40% admit rate, whereas the other one is probably 70 or 80% admit rate. University of South Carolina, out of state. This is after if you got a merit award. It's really actually about $55,000. I should have updated that. Berry University, 59, but they give substantial merit awards. University of Tennessee, out of state. These are, I spoke with Jeff, and these are some of the colleges that his clients are looking at. And then community college, it could be free because a student can borrow $5,500 if they file the FAFSA. So that loan is on their dime. And so no money to the family. And there's times when community college is the right place to go because the student is not a great student, or there's family issues that he needs to be living close to the family and taking care of a younger sibling or something like that. So it's not a bad idea to get 2 years out of the way at a community college and then move on to a state 4-year college, especially when you don't really know what you want to do. So what we're looking for in general is the free money. We don't really want to be saddled with loans, because you hear about that in the news that, kids are having $50,000, $100,000 of loans. Well, if you're scared by those numbers, in general, it's because the student is going to grad school. There's not a lot of money in grad school, or they're going to law school or medical school or PT school. In general, those are full pays when you get to that level. But for undergraduates, the maximum loan you can borrow is $27,000 over 4 years. So those students are not the ones that are getting into big trouble with loans. So there's two types of free money. One is need-based aid. These grants are determined by the financial aid forms that you file, either the FAFSA. All colleges want the FAFSA form. And then there's another form called the CSS profile form that the higher end colleges like Duke require. And they ask for income, assets, every line from your tax return. So it's kind of invasive, but if you're getting, say, $30,000 or $40,000 from a Duke, they want to see what your numbers are. So you can't get mad at them for asking those kinds of questions. And other schools are looking for high-end students, and they want to attract them by giving you a merit scholarship. And it has nothing to do with how much money your parents earn. So if you earn, you think, too much, and for a school like Duke, if you earn over about $260,000 a year, you're not going to get any need-based aid, or it's marginal, maybe $2,000 or something like that. So you might want to look only at schools that give merit money, or schools that are low cost, like your state schools, and receive the Zell scholarship or the Hope scholarship. So free money is the name of the game. And this is in general how kids look at colleges. Where is it located? Oh, they want California in the beaches. They want Alabama because of the football team. They want colleges for the location is the wrong reason for wanting a certain college, because you're only there for 4 years. Because if you got into Harvard and, you say, I don't like cold weather in the winter, I think you'd overlook that if you got into Harvard and they gave you a good aid award. So you need to think of other reasons to narrow down your list. There's about 3,500 colleges in the United States, so you have to start somewhere. Size of the school. Some people don't want to know everyone in the school, and so they want a big school like University of Georgia. But you can get lost there too. A lot of your professors will not know your name if some of your lecture halls are 800 students or something like that. You need to have the right major and the final list, okay, to determine your final list. But what's missing? And me being a money person, of course, I'm going to say you first should start on what can we afford. And when I work with families, that's one of the major questions that I ask. And I did mention that there's the FAFSA and the CSS profile form, and the profile form does ask you, what do you think your parents can contribute to college? And so if you make $400,000, you can't put $10,000. It's got to be more than that. But you have to, as a family, figure out what you can afford. And then I'll show you how you can identify affordable colleges as we go through this. And then you look at the location, the size, the major. And so you have a logical, organized way of doing this. And I don't want you to say to your child, just apply anywhere you want to go, and we'll see at the end what kind of aid awards we get. That's too late, because all of them have a due date. Usually it's by February 15th, which has already passed for applications. So if you wait till you get in, and the admissions offers are coming in right now in February, March, and the high end like Duke comes in April, and you don't get the money that you're looking for, it's a nasty situation at the end. Either the parents have to borrow, and they could borrow from the federal system at 7.4%. That's a nasty rate. Or you make your child go to a college that accepts applications at the last minute. They probably don't want to go there, but at least they can go to a college in September. So you need to plan. And no one likes to fill out forms, but to get any kind of aid, need-based aid, you need to fill out financial aid forms. And they typically open on October 1 every year. Now, with the new FAFSA changes, they are earmarking October 1 as their target date, but I went to a seminar put on by the Department of Ed, and at the end, someone asked the speaker, do you think you're going to make the October 1 due date? And she actually started laughing, almost uncontrollably. And she says, well, we hope to. And by law, they actually have till January 1 to get these things in, but it's going to cause a host of problems, because I think even the Hope Scholarship in your state, you need to file the FAFSA by a certain date, and we need that October 1 to be open for FAFSA so students can file it and get the Hope credit, the Hope Scholarship. So as I mentioned, there's two forms. One's the FAFSA and one's the CSS profile, and they're very different. I call it the FAFSA goes with a glass of white wine. The profile goes with the whole bottle. It's just a nasty form. It's about 15 pages or so, depending on your situation, and the FAFSA might be 6 pages. So every parent has a problem with it. And why you file the FAFSA? FAFSA is actually just a giant computer. They ask you for your income from your tax return, your taxes paid, what were your wages from work, how many kids do you have. They only use that for a deduction for family expenses, and what schools are you applying to. So this is how they use it. If Duke's 81 and the result of the FAFSA is a number that they think you can afford for college each year. So putting in $150,000 of adjusted gross income, so the family's income is $150,000. They have $60,000 of non-retirement assets, 4 in the family. Duke uses the profile and the FAFSA. The FAFSA number comes out to be $30,600. Well, the profile number comes out to be $30,600. And Duke is a school that fills full need. So if it's 81, they think you can pay 30, you have $51,000 of need, and Duke should fill the whole $51,000 for you. And that is amazing, because some schools don't fill 100% of need. And so if they only fill 80, you still have to come up with the shortfall plus your EFC. So it's a big ordeal to figure out what your FAFSA EFC is right now, so that you have some clue about how much the system thinks you can afford for college. See, this is how you can help yourself. If you figure out how much you can afford, And then you have to cut out colleges that are lower cost than your EFC, because then you wouldn't qualify for any kind of aid. And I just apologize. It's not my fault that it's so complicated. So some schools only look at the FAFSA, and University of Georgia only looks at the FAFSA. Most public schools only look at the FAFSA. So currently there's good reason why you might want to just find a school that looks at the FAFSA. Because if you're divorced this current year, only the custodial parent information goes on the FAFSA. So if you only have to put one income on there, not your ex-husband or ex-wife, then the EFC number should come out to be lower if the income for the family is pretty much cut in half. So that might be a good strategy to use if you're FAFSA. And they also don't look at the equity in your home. Profile thinks that, oh, you have a house, it has equity. You know, we'll use that as a resource for paying for college. So they take the equity on the profile side and add it to your cash, to the $60,000. And that can knock you out of financial aid or being a needy family quite, quickly. So this FAFSA, and later on, one of the changes with the FAFSA is going to be not the custodial parent's information. It's supposedly going to be the parent that contributes more money for the support of the student, even if it's the non-custodial parent. But I would try to manipulate that so still the lower income parent is considered the custodial parent, because you would definitely get more money from the schools. So maybe talk to me about that if that's one of your issues. Now, the CSS profile, that voluminous form with lots of questions, even if you're divorced, they generally look at both parents. There's a custodial profile and a non-custodial profile. And behind the scenes, they add them together because they know it took two to have that child. So they want to look at both. It's not fair, they think, if both parents aren't looked at to support the child. But there's some exemptions, like UNC Chapel Hill only looks at one parent, the custodial parent. So there's, maybe 20 schools that only look at one parent, but the other 200 look at both parents. And generally they look at home equity, but I've done a big study on home equity in some schools like Harvard and Princeton and all those, MIT, Caltech. They have so much money, they don't need to ding your house in the financial aid formula. So, if you're lucky enough to get into those schools, then home equity is not an issue. Though, if home equity is an issue, and in Seattle, our house prices are, $1 million is just a normal 3-bedroom, 2-bath, just, rambler. You can appeal to the college and say, please don't use the equity in our home because we've lived in it. We bought it for $200,000. It's now worth $1 million, and it's not our fault. We just need a place to live. So I've done that actually with my son that works for NPR. He went to American, and we didn't get the award that I thought we should get. And so I asked the lady, how do you look at equity in the home? And she goes, oh, we look at 100% of it. And at the time, our equity was $700,000 just from living in it for a long time. And so and then I called other colleges to ask them, and a lot of them capped it at a multiple of your earnings. So if you earned 100, they might cap it at 2 times your earning, or 200 and not use the 700. And so she agreed to do a multiple of our earnings. And so we got, I think, $6,000 or $8,000 more. And now I allowed him to go to American. As I call him the weasel, he only applied to one school. So we had to try to make this work. So that's a powerful number. And I have a list on my website, it's just paulabishop.com, that for handouts. And one of them is how colleges look at home equity in the financial aid formula. And remember, the schools that only look at the FAFSA do not include home equity. So if you're looking at just FAFSA only schools, then you don't have to deal with this. Now, I'm going to teach you 2 things that you can use to figure out whether you qualify for aid and how much aid. So do we qualify for aid? I want you to calculate your own expected family contribution, that 30,000 we saw in the previous screen, because it's like your blood pressure number for school. You don't want it to be like $110,000 because no school costs 110. So when I see a number like 110, I know that the family makes way too much money. They must make $900,000 or something like that. And you need to know that so that if you go to a Duke, you're a full pay. So to find it, you can just Google, go to College Board and say EFC Calculator, because that's one of the best calculators to figure out what your EFC is. And next year, they're going to call it the Student Aid Index, because so many colleges gap you that when someone sees that their EFC is 20, they think that that's all they have to pay for school. But if it's the Student Aid Index is the name, then they're more confused. They don't know what it is, but it really is your EFC number. And when I did it for Duke, well, I just put it into College Board. This wasn't Duke. So I entered all the information. You know, I'm just showing you what you'll see when you go to College Board and try it. At the end, they ask you, do you want to use the federal method, which is the FAFSA method, or the institutional method, and that refers to the profile school. So on the federal method, putting in the same data, for FAFSA, they think you can afford $32,975. And on the institutional method, which is much more generous in the formula, it's only $28,440. And if you have no home, then the profile, it might be 17,000, because in this example, I have 200,000 of home equity. So don't be afraid of profile schools, other than the fact that you have to fill out the form, because those are the schools that have more money. And that's why they want you to fill out the form, because they've begged their alumni for many, many years to have this endowment fund, and they want to make sure that you're a truly needy family. Whereas a federal form, there's different formulas where you could be making low money because you're retired, but have lots of assets, and they ignore your assets. So people play around with the FAFSA to, qualify for more aid. But the profile, it's like you can't hide. And this is just a basic chart about what your EFC might come out to be. So if the parent's income is 50, 100, 150, 200, and you only have one in college, they only want you, if you have 50,000, because one is unemployed or something happened or one's sick, they only want you to pay $4,000 a year. That is not bad, but then it shoots up pretty quickly. On 100 grand, they want 20. On 150, they want 38, and 200, they want 55. And most parents go, and I know Jeff works with you to say, how much do you want to pay for college? Let's put it in the 529. But life happens, and 529s in general are woefully underfunded. And if someone's not working with a financial advisor, in general, they don't have anything in a 529 or any funds earmarked for college. They just think that they'll take it out of current earnings or tell the school that they can't afford anything and they'll get it. No, you got to deal with how the system works. And currently, if you have two in college, the FAFSA divides the number in half. So each child only, they want them to pay 2,000 or 10, 19 or 27.5. Now you have two children, so you have to pay 10 each if you're earning $100,000. So it's really 20, but at least you get a multiple discount for having two in college. Now, the new FAFSA changes is getting rid of that multiple discount. So people are in arms about it on my side of the desk. But, we've petitioned and it doesn't look like it's going to happen. Congress thinks that you planned having two kids at the same time so that you can get a deal when your children go to college. I started laughing controllably. You're just so happy that the kid is born and normal and wants to go to college. You're not thinking about having two in college at one time to get a discount in the cost. So another issue is, it's called the net price calculator. it's a wonderful tool that colleges were forced to put a net price calculator on their website that estimates how that particular college gives out aid. So you put in, it's sort of like the FAFSA, you put in your income, your assets, your equity, if it's a school that looks at equity, and at the end, it gives you a sample award letter. And that's wonderful. So, you know, garbage in, garbage out, more or less. So if a potential client of mine says, well, it says I'm supposed to only have to pay 10,000 and I know that they make 200,000, I know that they entered the data wrong. So we'll go over the entries for the net price calculator to see where they went wrong and come up with a good answer. Because many of them are pretty accurate. Some are not accurate at all. I looked at University of Georgia, and the government has a free net price calculator, and of course Georgia uses the free one. And the highest income level, it says, do you make more than $99,000? And that's a dead giveaway to me that it's the free one and it's not accurate, because if you make 110, you get the same answer as if you made $4 million. So it's just not a useful calculator. So I picked actually 3 colleges that I'm going to go over, but this is a high-end college that uses the profile form, and they hide it. It's way down here, net price calculator. So what I would do is, if you're looking for it, go into the school's website and just put it in the search field, net price calculator, because they're supposed to call it net price calculator. That's a technical word, and you should be able to find it. And if you can't, let me know, or call the college, because by law, the Department of Education laws, they have to have it, or the government will take away their FAFSA ability and their student loans and any kind of federal aid. So it's on every school's website. Now here's another sneaky one. This is on Duke's website. They have 2 net price calculators, they say. One is called My Intuition and one's called Net Price Calculator. Now, My Intuition sets a quick ballpark estimate of your cost, and it's only about 8 questions or 6 questions. And the other one is maybe, 20 questions. And the actual net price calculator on the right is much more accurate. I'm finding the difference in awards are about $10,000. So I think the first one is not very useful to anyone, because it's deceiving on how much aid they might give you. It gives you more aid than really you deserve. So go through the longer one. I just want to warn you that that's a problem. It's only come up in the last 2 years, because parents don't want to spend a lot of time on it. So they go with the easy one that says eight questions. But 8 questions are not enough to get through the financial aid formula. So, shoot, this is the wrong screen. I actually have Kennesaw, Duke, and Berry College. I don't know why that one's in there. Let's see here. Oh, I know why. I'm in the wrong PowerPoint. Jeff, do you mind if I change my PowerPoint? Because
that'll be fine. I'll turn off the screen here where they don't see your screen briefly. They'll see my screen and my.
Okay, here it is.
See my terrific team while they're waiting.
Okay.
And switch it over, and
Sorry
then when
about that, because I made a backup of it, and I didn't. I brought up the backup this morning, which
no worries.
So now I'm ready,
okay.
But
so now you've got to hit the button. Yeah, now you got to hit the button again to share your screen, and then okay.
Yeah, I need to display settings and swap. Okay, show my screen. Okay, here it is.
Okay.
So you have the right schools on there, right?
We do.
Okay.
Hey, we did that pretty good. We did that pretty good. I'm glad we practiced.
Yeah. Okay. Practice makes perfect. Okay. And since I didn't like the University of Georgia's net price calculator, I went to Kennesaw State, and they have a pretty accurate one. So I use that as an example, Duke and Berry. because one is very, Kennesaw was 27,000 or something like that, 25,000 a year. Duke is 81. Berry is, close to 60. So for Kennesaw State, the student has a 3.8, $150,000 of income for the family, and their EFC is about 32. And since the cost of it is lower than 32, the family does not qualify for any need-based aid because they have no need, because the cost 21 minus 32 is negative number. So all they can hope for is some kind of a merit award. And because of the Hope Scholarship, this is what the award letter might look like, because at a 3.8, they should get the Hope Scholarship. I think the cutoff is 3.0. They can borrow if the parent is low on just cash flow. The student can borrow $5,500. So out of pocket to the parents is only $11,000. And that is a wonderful number, 11,000 for college. You don't see. And so when you're saving for college in a 529, and this is your target school and your child, is happy to go there, it's only $40-something thousand to go. And that's only a half a year of Duke if you didn't qualify for aid. So even a rich person can go to Kennesaw State for $11,000 because his student is a 3.8, gets the 5,000. So that is like the deal of the century. Now Duke, tuition 60, so it's 81. Do you get more for your money, going to a Duke, or is it, giving you success in life? Not necessarily. So 81. And based on, you have to be at 4.0 to get into Duke, but on the same stats of 150,000 income, and they use that CSS profile form, and they think you can afford 3,600, they will give you a need-based grant of $43,000, well, 44. And I've seen this over and over again at these high-end schools. If you're making 150, they give you a substantial grant. You can still borrow 5,000. The Duke on the award that I saw said $5,000, but you can borrow up to $5,500 at 55. So at 5%. They also give you a work-study job because they feel that students can work. And so out of pocket is $30,000. And that is not a bad number for a school that costs $81,000. Now, why I picked Berry is that it's not, a Duke or a Emory or something like that, but it is a private school that can give substantial merit scholarships. And then I find out that Jeff's son went there for a year, but it's a school with about 2,200 students, and some kids don't want a small school like that. They want the big one with football team and all that kind of stuff. So, go back one. So for Berry, it's still a 3.8 student. The EFC is 32. So what happens is that Berry is trying to attract high-end students, and a 3.8 at Berry is much higher than the average GPA that the school allowed, for the school, which might be a 3.2 or something like that. So because of the 3.8, they want to offer the student $19,000 in a merit award just for his grades. And then they also get the Hope Scholarship because that's an entitlement, having a high GPA. And they also get another grant from the state for $900. Berry's throwing more money at this kid, with a scholarship that the alumni group raises every year, and the loan. So for Berry, out of pocket is 24. So now if a student is looking for a smaller school where the teacher, professor will know their name, and they have, academically, it's a wide variety of majors, and they have nursing and many other majors. So look at their website, and it's within driving distance. It's actually a good college to look at if you're looking for small and personal. And you can talk to Jeff about it because his son went there. And then when I do this for, say you're looking at 10 colleges, I make a worksheet so that I can compare them one after another. So the full price is 21, 81, 57. And if you look at Kennesaw's website, it might say 25 because they have a lot in travel. And to me, you don't have to fly there. You can just drive if you're from Georgia. Books is just an average of 1,000, and miscellaneous on the weekends. It depends on your student, how much money they spend, but you can get by with 21.8 at that school. And then the aid that they get. And so the bottom line is 11, 30 for Duke, and 23 for Berry. Now, if you decided that the family could afford, say, $35,000 a year for college, and that's what you have in your 529, all these schools are possibilities, and many more colleges are possibilities. On my website, if you're a high earner, I have a handout that is, I think, 6 pages long, and it's by college. What is the average merit award at this college, and what percentage of the students receive that merit award? So it's one of my colleagues creates this every year, and it's a valuable resource if you're looking for colleges that give merit. And most of the merit awards are given by private colleges, but I would think that any resident of Georgia is attracted to that Hope and Zelk scholarships that you just get for being a good student and not based on your income. And that makes college reasonable. So your family might not be tempted to go out of state or to go to a private college, but that's a discussion that you have to have with your student and the whole family, because it's a big cost difference, as you can see. So I want you to try that EFC and also the net price calculators. Now, if a family is heavily into deciding, on colleges, they went to Yale or something like that, and they think that their child, there's 2,900 four-year colleges in the United States, and the Ivies aren't the only ones. And I'm finding that if the student goes to a private high-end high school, they're more apt to want to go to the Ivies or to the top 50 colleges of the United States that are merit. They're only need-based schools in general, because like, does Harvard have to give you a big scholarship to go there for your grades? Everyone's a 4.0, 800 on their SATs, so they don't have to do that. So they only give out money based on need. And on my website, there's the first handout is, it's 55 colleges that don't give merit. They only give need-based aid. So if you don't qualify for aid, then you're a list price at these schools. And you have to decide as a family if that's what you want. And really, where do kids go? This was a survey done, and public colleges, 77% of students go to, like, University of Georgia, Kennesaw State, the state schools, even here, University of Washington. And all other private, those are the Berry colleges. And the highly selective is only 3%, and that's the top 70, not even just the Ivy League. So kids aren't going to those schools. They're going to reasonably priced schools and getting merit money that's attracting the student and the family to these colleges. And where did the top CEOs of major corporation go? They went to big state schools. That's where they went. Learn the nuts and bolts of business. And where does money come from? 98% comes from the colleges themselves. An example is Berry. They got the 19, they got the Hope, they got, another, a couple of different scholarships. And if you're looking at these outside scholarships of Kiwanis and Rotary and things like that, only 2% finance college. So I would first start with what colleges give merit awards, and I would look at that worksheet that I have on my website. And I don't even worry about recruited athletes. If you're 300 pounds and you can squish somebody by sitting on them, you are being recruited by some football team for college, and you know who you are. So I don't even worry about that. And of course, that what's attractive to colleges? They want good students. They don't want students that will drop out. So GPA, and I would not take the SATs and ACTs. I know kids don't want to take them, but it gives you more options, because it's just another way that a college can assess your students, so it doesn't hurt. And if it's not a great number, don't submit them. But if it's a good number, it can definitely help you. And activities, talents, they don't want a well-rounded student. They want, in general, somebody that's passionate about something. And every school is different. And saving, I'm sure Jeff, if you're a client of Jeff's, he's talked to you about 529s, but grandparents can own it. If a student has money in their UGMA accounts, you can move it to a custodial 529. So it's not digging in the formula too much, but I can talk to you about that. In general, I meet people in junior year of high school and they haven't saved enough. And 529s, it's like too late to start funding them to any big advantage, because the advantage is it grows tax-free. But if you need it in a year, then the growth potential is not that high. So I would just use my regular non-retirement funds. But, you can discuss that with Jeff about where you would get your money from for college. And maybe you just go to the state schools that are very reasonably priced. And I can't force you to do this, but I really do want you to figure out your own EFC so that you know what side of the fence you're on, whether you're on a need-based family or not. And it's okay not to be a need-based family. And if you're not a need-based family because you make too much money, then you might want to either go to lower cost state schools or access the net price calculators to see what kind of merit awards your student might get if it's a private school, or even an out-of-state public occasionally gives, $5,000 or something to a really good student in another state. So now that you've done those things, then you've already addressed what we can afford, and you've agreed as a family about what you want to pay. You found the affordable colleges because you did the net price calculators, and then you can go to the location and all the majors and all of that. And now everyone's happy, rather than your students saying, I can't go to where I want to go, where you can hope that they don't get into one of the schools they want to go to. So that way you don't have to pay for it, but that shouldn't be your goal. And so that's the end of what I wanted to cover. And as you can see, it's pretty, it's involved. And I do give consultations if people have crazy questions. And I help. In October, November, I spend a lot of my time reviewing FAFSAs and profile forms, because in general, people don't fill them out correctly. And so I'd rather have them go in correctly rather than have to beg for forgiveness later when you don't get the award that you were thinking you would get. And then looking over the forms after the fact, you realize that the parents put in the wrong numbers, and then we have to appeal to the college to reverse some of that stuff. So that's it, Jeff.
That is terrific, Paula. Thank you for all of that great information. As is typically the case on some of these webinars that we do, we don't have a lot of questions. I find a lot of our attendees would rather reach out individually or after the fact. But we'll give it a couple of minutes here. Let's see, I have one here. Let's see, I've got one. I'll just read it and then we'll try to interpret it together. So one of our attendees has asked, do the same set of rules apply for higher education, such as dental or medical schools? So can you shed any light?
Yep, I can.
Student
it's called ChFC. It's called ChFC. I don't specialize in grad school because I find it depressing. You are so happy to get into a dental school, because I forget how many there are in the country, that you're more or less forced to just work with whatever financial aid policy that school has. Now, I have an unusual character, that student that ended up getting into 14 medical schools, and that is highly unusual, but he's unusual. He's 36 or something. He already has his PhD in medical history. So colleges wanted him. And now he got into Stanford. Stanford does look at the FAFSA, and they gave him full need. his EFC was like 30 because he was working right before he went into medical school. And so he got a $70,000 award, but he had to pay 30, and it cost $100,000 to go to medical school. Johns Hopkins gave him a full ride because they just wanted him. Northwestern gave him absolutely nothing because they don't want to give money to medical students. Kaiser in California gave him a full ride because they haven't had many graduating classes. In dental school, you know, you would call the dental school, find out what their policies are do you give need-based aid? Do you give merit awards? So every school is different for these high-end professional, you know, schools. And you can't pick the schools by which ones are most generous, because if you apply to 20 medical schools, you might get into one or two. And so you're stuck with those one or two. That's for the average person. But for this unusual kid who already has a PhD, you know, they were after him.
Yeah.
And,
yeah. Well, that's great advice. I don't know that that's the encouraging is with
I know, it's terrible if you want to be a doctor.
Yeah. So you need to do the research with the individual schools and see what if anything is available. But there may be nothing. Okay,
and
good.
see, you can also borrow the whole cost of medical school. So you can come out with $400,000 or $500,000 of loans. That's when you get on TV and they say, this is the crazy family that has $400,000 of loans. But Biden has and it's been you know, it's been around for a while. If you pay your loans off for 10 years and you still have a balance, and on 500,000, you will have a balance, they relieve the rest, they erase all the rest of your debt if for those 10 years you work for a nonprofit. So you can work for a nonprofit hospital, but you have to make sure it is a nonprofit, because some hospitals are owned by a for-profit corporation. So they changed the rules so that every year you have to certify that where you work counts for this debt relief after 10 years. So that's a good way to go.
Yeah,
is to get your loans relieved.
All right. I do have another question here that I'm happy to try to field, or you can. It's, if not all the money in a 529 is used, what happens?
Well, it's just another pool of money for pay for college. So if you used it all, then you have to use your other money, you know, your other non-retirement assets, or your Roth IRA, or beg a grandparent to help out or something like that.
Yeah, I think what they're asking is, you're through paying for college, but you still got money in the plan.
Okay. All right. Right now, this past year, they made a law, you can move 10,000 of that into a Roth IRA. So you get rid of 10. You can use it for grad school. You can give it away to other family members or cousins or something, or you can just cash it out and you pay tax on the appreciation of the 529 because you didn't use it for college. Or you can pay $10,000 of student loans with the excess money that you have.
Right. Yeah, and if you do cash it in and you don't use it for college, you pay tax plus a 10% penalty on the growth. The principal would, of course, come out tax free. And again, you know, if you're optimistic that you may have grandchildren one day, you can change the beneficiary if you own the account. And if it's a custodial 529, it would be a little different. But if you are the owner and your child is the beneficiary, there's nothing to say you can't change it to a grandchild at some point in the future as well. So there are some options. The new rule with the 529 just came out in terms of the Roth conversion feature. And it's a little more complex than some of the headlines, so we would want to talk about that with you. There's a number of stipulations, but that is potentially an option for some of it. Any other questions?
Yeah, no, I don't even think there's. Is there an age limit? Like if you by 35 or something, do you have to use the 529?
No. So yeah, so you can actually make yourself the beneficiary, and you know, I'm thinking about you know, taking golf at one of the schools. You know, just change it to yourself and go take a course if you wanted to. But you can only do that once a year, I believe. I believe changing the beneficiary is treated as a rollover, which you can only do once a year. And if you change the beneficiary, I believe that also changes the clock on the new provisions around the Roth conversion, because there is a time limit that the money has to be in the account to convert to a Roth. So suffice it to say, it's a little more complicated than just a blanket answer, but we would be happy to help you with that, and ask Paula if you have questions. Any other questions? I don't see any other up. Let's give it just another minute here, Paula. This has been really helpful. I know in our planning, we attack it so much in the planning and building wealth to pay for college, and there's a huge need for navigating the complexities between merit and needs-based benefits. So I really appreciate all of this great information. I'm sure our audience does as well. As I mentioned, TandemGrowth is here to serve you and help you. If you have any questions, don't hesitate to reach out to anybody on the team. You can see our contact information there on the screen. As always, it's been our pleasure to spend some time with you today. Hope you found this useful. If you have any questions or we can be of any assistance at all, please reach out. And again, Paula, thank you so much for being a collaboration partner of the firm and your great information today. Thank you guys, and have a great rest of your day. Take care.
Bye-bye.